Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
We are honored to have as our guest Ms. Joelle Faulkner. Joelle is the president and CEO of Area 1 Farms, the largest farmland investment fund in Canada. Prior to Area 1 Farms, Joelle received degrees in engineering, law, and business, and worked at Bain Co, Morgan Stanley and Onex. She is a Rhodes Scholar, Fulbright Scholar, and a future leader in Canada's Most Powerful Woman, the Top 100. Joelle has been named a Young Global Leader by the World Economic Forum for 2020. Canadian farmland has averaged over 10% returns in the past 60 years, with no down years over multiple recessions. Why is farmland investing a fantastic long-term recession-proof investment, even among the COVID-19 crisis? Find out from Joelle in this hour-long interview and Q&A.
I run a company called Area 1 Farms. Area 1 manages limited partnerships in Canada for investors. We have a mix of high net worth and institutional investors, and our assets under management are about $350 million between 4 funds. So the first 2 funds were small individual investments with family offices. The third fund, we raised about $135 million, and in our 4th fund, we're at 160 so far of what we hope will be about 300 million. It is a Canadian figure, like all the numbers I'm giving you are Canadian. And we invest in farmland. I got into it because my parents are dairy farmers, and my brother was running the farm, and he wanted to expand outside of Ontario, which is where we were. And I got interested. I helped him buy some land, and I got really interested at the time in why people aren't broadly investing in this asset class, what makes it different from other asset classes, and how you might invest in it with better outcomes than what the present model was. And so farmland investing, I'll take you through that with sans questions, but our approach to it is a little different than most. And so most funds, especially in what's row crop commodities, so annual crops, would buy land and rent it out, and often they rent it back to the person they bought from. And our approach is to partner with farmers in rural Canada and to help them expand their operation. And so we're usually the growth equity for intergenerational transfer or intergenerational growth, so to accommodate multiple kids coming back to the farm. And so that's our history and our approach. We've been doing it 7 years. We have kind of a unique spot within the Canadian ecosystem. We are building a bit of a brand within Canada, but still really small. All of the investment together, not just us, but all the investors would be under 0.1% of Canada. So it's not a significant investment kind of when you look at the space at all. Oh, Sam, I think you're muted.
Yeah, Joelle, you do have a very unique business model, at least from what I've seen. So we can go into that later, but maybe we could tackle the macro first. Can you just share with us sort of this asset class, farmland in general? Why is it a good investment? Why is it not? And then obviously as it relates to Canada, I know Canada has some special features that you've explained to me, but maybe you can explain to the audience that first.
Perfect. So, the reason that that we get interested in farmland, and the reason that farmland has been popularized as an asset class, is it is diversification for portfolios because it is not correlated to other assets. And that has been tested on a number of occasions. Housing crisis being one of them. Farmland continued to go up. In the recession in the 90s, farmland continued to go up. The recession in the 80s, farmland continued to go up. With a bit of an overlap actually to other movements in farmland price in the 80s, but for different reasons. And this one, same thing. So we did not see the volatility in farmland values that we saw in the rest of the market as a result of COVID-19. And what's interesting about that is until we had gone through that part of the cycle, I actually wasn't sure if the reason that you didn't see the same thing in farmland was because we just mark it to market. We mark it to market too infrequently to see the kind of volatility. But even the sales that we participated in during the period where everything had fallen and nothing was coming up, farmland continued to hold its value and appreciate. So we were unsuccessful bidders in the sales we participated in because we were looking to buy at historic numbers, and instead the land sold at historic highs. And that, to put it in context, was also in Alberta, where not only are you seeing the effects of COVID-19, you're actually also seeing the effects of very low oil prices. So I think as we think about that, or as you look at the asset class, the reason that we get investors so interested is diversification and non-correlation, and that has proven out even in the current circumstances. So it's kind of an interesting time to talk about it.
Can you talk more about this non-correlation? Why is it not correlated, and what is it correlated to? What are the drivers?
So in other countries, it may be a little different, but in Canada, the very vast majority of farms are owned by farmers. So they think right now about 99.9%. Most of that land is owned and operated, with a minority, what's believed to be around 30%, being owned by a farmer who's now retired and they're renting it to a neighbor, or the family has inherited it and they're renting it to a neighbor. So it's a market that is really built by its neighbors. And if you want to think about it in residential terms, it would be like so it trades actually a lot more like residential real estate than it does like commercial real estate, meaning higher value areas beget higher values. So it's trading as comparable property, and areas actually make a difference. And if you want to think about it a different way, if you, as a family expands, if all the kids bought houses on the same street as the parents, then the houses on that street would actually continue to go up in value because there'd be a ready set market. And that's what you see in farming. So in areas with higher values, that's usually because there's a couple neighbors who are successful farmers who over time would like to buy more land. You see a little bit of the same effect in the US. The US has inheritance taxes that mean at generational change, there are real estate taxes to pay. So disposition or deemed disposition. In Canada, as a result of tax rules for farmers, there is no deemed disposition when you pass on a farm to your kids. So if the kid, it's actually a much easier economic proposition for kids to come back to the farm. And as they grow, they become the competitors to other buyers for that area.
Okay, I'm not sure if I entirely caught that. You mentioned it trades like residential. When you say it trades like residential, do you mean that it's correlated with that? More correlated with that?
No.
You meant something else?
Yeah, no, not correlated. I just mean from a thought perspective. So it tends not to have, it has slight correlation to long-term interest rates. It has slightly negative correlation to the stock market, which I actually don't think, like it's negative 4%, but I don't think it's really negative. I think it's just mostly not correlated. Like I don't think there's a consistent driver. There probably is a bit of an interest rate driver, but again, it's only thought to be about 12%. And so the driver is really productivity and profitability. So they think the biggest correlation is to revenue per acre, and revenue is based on the type of crop that you're growing on average and its average price. The Canadian dollar hedges out about 70% of crop price volatility, and the value to the land isn't actually based on what it produced the year before. It's kind of what it on average is expected to produce. I think more than that, the value is based on demand from local buyers, and the local buyers really depend on how strong your local farmers are. But what you have to remember in this particular industry is if you're a strong farmer, you also have a land base in that area. So if you pay more for land around you, your own asset is probably also going up in value. And so it is uncorrelated. I guess the other things that people would generally invest in: stocks, bonds, real estate, both commercial and residential. I think it probably, so when you look at Canada's history, it ties really nicely to profitability, which is both the mix of productivity of the land, so bushels per acre, and price of the commodity.
Okay. So I think the first or second time I met you a year ago, you did show me a slide, which I think is what won me over to this asset class. I think you showed the past 60 years or so of Canadian farmland prices. And on average, I think an average over the 60 years for the national, it was 10.6% increase per year, right? Of which obviously it's differentiated by province. Ontario looked really good. And as I recall, I think the worst year was at 5%. I'm not sure if it's been a while, but I think there's some questions coming in. So if that's true, please correct me if it's not.
The only correction is the number you're thinking of. So the 10.6%, that's the mix of both income based on renting it out and appreciation. So Canada's long-term appreciation, 20 years and 60 years, is 7.4% a year.
Okay, yes, it was renting out the land or the production, the yield from production, as well as appreciation.
Correct.
Right?
Yep.
So which is fine, because we're investing for both, and I think that's one of the questions posed by Clifton. So what I saw there is, for example, Ontario, closer to metro areas, the increases tend to be really, really nice, like 20% in some years, 15% in some years. So is that really tied to being in a place where there is development area where you get nice juicy capital gains, right? So that's really one question. And then the second question is, can you talk a bit about, in the past 6 years, during economic downturns, global or certainly North American, how did the farmland asset class react? And then lastly, related, is this time looks different because we are getting disruptions in supply chain. So how do you see sort of this time around being different? Sorry, there was really a bunch of questions in there, but
okay.
Yeah.
Okay, so when I'm talking about farmland, I am talking really about farmland that doesn't have the effect of residential or even of recreational, so cottages, country homes, that kind of stuff. So when you think of Southern Ontario, where you get a lot of population, that's actually not what I'm talking about in general.
Okay.
So it falls into the 7.4%. It falls into how we think about things, but it does have other aspects to it. And there are the long-term possibility change in use and capital gains in those places, but we're just talking about farmland. So what I tell people to think about is, assume that you are flying to a city that you don't necessarily want to spend time in, and then you're driving 4 more hours away. That's the spot we're talking about.
Okay.
Thing.
Okay. So your model isn't really trying to punt in a place that might get bought up to build condos. Your model is really farming.
Yeah, because I don't want the correlation. So if condos go down, I actually don't want to be sitting on $30,000 acres or $400,000 acres. I want to be on $2,000 acres or $4,000 acres. Gotcha. Okay, good. Thank you. So that segues into the business model, because let's take the 10.6. Again, we don't need to go into detail, but I know that net of fees, your funds return better than otherwise, so you can't justify your existence, right? Yeah. So can you explain what you guys do, the business model, and how you generate, obviously, returns for investors? We partner with farmers. We think that local farmers in Canada buy better, so they actually buy better land. They buy it at better prices because it's generally in off-market transactions. About 85% of Canadian farmland trades off-market. And they operate better, so they maintain the land better. About 25 to 50%, depending on the portfolio, of the work we do is actually land improvement. So we buy land that has historically been farmed, but fallen into disuse, either grew over because the guy took a job at a mill or a mine, often was timbered. So in the last 10 years, had grown fully trees, they take the trees down, but now there's kind of just waste. We get rid of the overgrowth, we put in the drainage that it needs, and we turn it back into farmland. That is a very, very active management strategy, and we aim to almost double our investment on those properties. So our properties are a mix of farmland that we think will have really nice passive return because of appreciation, a bit of active return because of farming, some years strong, some years poor, depending on the weather. And also this kind of actively managed appreciation that we seek to get through land improvement work. And that land improvement work helps reduce hunger. Like when you think of it kind of on a global scale, you're creating more food, so you're helping with the hunger problem, you're giving Canada a greater GDP, you're improving the economy locally, and you're actually able to buy stuff that other people aren't that interested in. So you have to know what you're doing, you have to be able to do the work and finish the job, which is tricky, and you have to finance it. There's a question on here about what kind of leverage do farmers use? We use 30%. That's probably not that dissimilar, so fairly similar to what other farmers use. The banks lend you a lot more, but as you get higher with leverage, you're in a riskier business because the cash flow servicing will depend on weather.
Can you talk us through a typical deal?
Sure.
Yeah.
So I'll talk you through one we're doing now. We have a potential partner. He has, so it's a couple. They have 3 kids looking to join the farm. They were farming about 4,500 acres. They owned 1,500 of those. They rented the remainder. They lost 1,000 acres of their rented land. So now they're at 3,500 acres for this year. They think they're going to lose a bit more of their rented land. So as it sells, it'll sell to active farmers. And their 3 kids want to come home and farm. So they need to turn a 1,500 acre owned farm into, give or take, 9,000 to 12,000 acre farm to support their kids as full-time farmers. And so we're doing that. So we bought 1,000 acres with them that will require improvement. We bought the improvement machinery. We're improving those acres and bringing them back into production. And once we know that they can do that well, they can manage it well, they have the ability to oversee that kind of project, we'll expand with them. And we'll aim to get to about 7,000 to 9,000 owned acres with them. Sorry, Sam, you're muted again.
Can you talk us through the investment model?
Sure. So we put in equity and the farm partner puts in equity. We borrow 30% debt, so loan to value. On improvement work, we actually borrow it after it's cash producing, so after we've cleaned it up. On ready-to-go farms, we borrow it at the beginning. In addition to the part the farmer owns, they actually, under our model, they, for their time, earn a portion of income and appreciation. So they'll earn 15% of income and appreciation for doing the work and managing it. It means that they're incentivized and aligned with us to buy really well, to efficiently improve, and to create strong and profitable operations. And we do different things in different cases, but that would be our most common.
So you find an existing farmer, they're obviously dedicated to family, they're already farming. They want capital or potential expertise partnership from Area 1, right? Yep. You give them some money, but they put in what half? They put in a minority. How much do they put in? They put in skin in the game.
Yeah, usually it's a minority, because if you think of those proportions, even with that farmer where they have 1,500 owned acres, let's say they put in their 1,500 and we're going to grow to 10,000, they're a 15% partner.
Okay. And do you take ownership of the entire, because they have existing land prior to you, do you take ownership of the entire thing, or do you take ownership of the new land that they're expanding into?
It depends on the partnership. So
okay.
We try to operate as a single farm. So even if we don't take ownership of their 1,500 acres, we actually have theirs as part of the average. So we're farming it all.
Got it. Okay. Time frame and exit strategy?
Yeah, so we're 10-year agreements with our partners. So we agree on both sides that we'll operate for 10 years. Then we can keep agreeing, and it's 5-year increments after that. Exit strategy, they will buy part of the farm on exit, so the part that they can afford. We'll either sell the remainder to other farmers local to the area, which is how we model it, or I think that there is actually pretty strong demand from funds, so from pension plans, especially in Canada. And should those groups be interested in partnership, it seems likely to me that the farmers will be interested in continuing a partnership. And so we can get bought out potentially on a whole fund basis, which we think there'll be a premium for. We don't work it into our numbers just to be conservative, because we think that would be a premium to just selling the assets. But either way, totally works. And from a fund timeline, so how we think about these partnerships, we try to pick partners who will be partners for 10 to 25 years. We agree to 10 years, and then it'll depend on investor preference and farmer preference at the 10-year point.
In the 10 years prior to exit, can you talk us through the cash flows? Is there any dividends and how that's,
Sure.
Yeah, from the investor standpoint?
So rental rates in Canada are between 2.5% and 3.5%, meaning after you make any payments from them and management fees, there's not much left. Operating, we think, is probably from about 4% to about 7%. So again, once you make payments from them, there's not a ton left, but enough for a dividend. We don't start the dividends until year 5 because we are investing so much in the cleanup work, the improvement work, and that takes time. That instead of investing, calling capital and distributing at the same time, we wait and do distribution in year 5 and after. So that's our approach. We expect that the cash return from this is only going to be 2% on average. So it'll start at 2 around year 5, it'll grow to 6 around year 10, and it'll kind of be going up in that period. It depends on weather and operations, but that's kind of the approach we have. If you were doing a different type of farming, so just to be clear, there's if you think of farming, there's row crop commodity, which is what we do. So wheat, canola, oats, soybeans, corn, anything that you're planting every year and in rows. There's permanent crops, so orchards, oranges, pistachios, almonds, figs, grapes, blueberries, all that stuff. Those things have set lives. So you have much bigger income, or you should have much bigger income year to year. But at some point, you have to replace all your trees. So your land isn't worth $40,000 an acre now with mature trees. It's worth $20,000. You have to spend 20 more on new trees. So we're a really low cash return type of farming. And the way we're doing it, because we're so focused on land improvement work and really creating value, we actually then are also not so focused on cash income and returning that in early years. So we will see much higher total returns, it's a goal, and higher appreciation, but lower cash yields than other methods.
Okay. I think you once told me that Canada is only one of 2 countries that benefit from climate change. Again, back to the macro, maybe you can, I'm not sure, can you also cover that, and also your thinking on this time around with COVID, especially in your assets and your crops that you're growing, whether you see this being a different than the past 60 years?
Sure. So, we're not one of 2. We do generally benefit from climate change. So does the northern part of the US. Depending on how crops are developed, Russia and China will also benefit. So you kind of take your northern climates, they generally win. Your equator climates generally lose. And it's actually less, if you want to think about it, about temperature. So it's not so much that we're getting warmer, though that's helpful. It's actually that we get a bit more rain. And in the middle of the world, so close to the equator, you're getting drier, and drought is already a problem. So that's kind of the expectations on climate change in a really rough way. The
COVID impact, whether it's different, because it is different. This is not the same type of recession, right?
Yeah, it's very different. So COVID so far has really significantly impacted processing much more than supply chains. So there was worry on the crop level, would fertilizer make it to Canada? Will grain make it out of Canada? And the answer on both of those questions so far is yes. And because countries are very focused on food security right now, it looks like everybody is going to do everything in their power to keep those movements happening very efficiently and effectively. So our specific type of farming is actually not very impacted by COVID. And to some extent, we're seeing a rally in wheat prices because of increased demand for wheat and flour. And that's not just because people are baking at home now, it's also because countries want food security. And so they would like to have a reserve of wheat. Okay, there's other pieces that will matter when we talk about land price in general terms. So beef, dairy, chicken, things where you're producing vegetable fruit, where you're producing a product and that product needs people either to process it, like in kill plants for beef or hogs or chickens, or you need people to pick the vegetable or fruit. Those are all finding big problems in terms of operations at the moment. And the market is, as a result, depressed. It's not expected to stay depressed because the demand is still there. So as soon as the kill plants can work, it's expected that beef demand will be maintained. And as a result, the market on land isn't negatively affected yet. So, and we don't actually think it will be. So there is a question on institutions can live off increased NAV, but people really can't, like farmers can't, they need income. And that is true, but individual family farms, which is what Canada's made up of, so it's not huge conglomerates, it's families still farming mostly themselves. They have a couple hired people, on average probably 3 on a crop farm. They can actually live pretty leanly, so as they need to. So bad weather isn't really a major problem. I said to somebody recently that it's actually a bit of a shock to me that the whole world and the businesses are being really, I guess, teetering on the edge when you have a 20% drop in revenue. Like if you say, okay, revenue for everybody is getting wiped out for all of March and all of April and some of May, you'll be at 20 to 25% of revenue for the year gone. And you assume, let's say, that the rest of the year is kind of fine. To me, it's shocking that that can wreck a business because in row crop commodity land, that's just called weather. Like your weather can actually swing you by 25% in any given year and will make a much bigger difference to row crop farmers than COVID will. So they're just, I think the whole system is set up, it's why the low levels of debt, et cetera. The system is set up really conservatively to handle pretty big swings.
Okay, so prediction next 10 years, 20 years, do you see any major differences going forward for your asset class?
We think that we'll continue to see appreciation kind of in the 7% range, so somewhere between 5 and 10. About half of that we think will come from increased physical yields, which are rising depending on the commodity type at actually 2 to 5% a year. So really good for yield increases because of better technology across the board, better machinery, better seeds, better fertilizer placement, like all the things that we're learning at any point. And in Canada, I expect that we will also see some benefit from the introduction of warmer climate crops. So soybeans and corn, which even though you hear about low prices and historically low prices, that is true in a US dollar term. It's true in kind of recent years, like last year was 3% lower than the 5-year average in Canadian dollars, but your yield is increasing so quickly that the two offset. So we would actually still benefit from a profitability standpoint by introducing corn and soybeans when those are ready. for our climate. And to put that in context, they are growing totally normally and have been for 15 years in Southern Ontario, Southern Quebec. So when I'm talking about this, I'm really talking about the prairie provinces, Manitoba, Saskatchewan, Alberta, your more northern climates.
Okay. There's a bunch of questions. Let me try to just paraphrase and summarize, and please correct me. I think as an asset class, you're saying your investors are interested in farmland. Obviously, as a long-term asset class, Canada farmland has done quite well, right? Again, if I recall correctly, during the same decades-long periods, I think U.S. equities is more like 8%, Canadian equities like 7%. And then, so if you threw a dart at a Canadian farmland, you held it for a long time, then you're, two basis points above US and 3 basis points above Canadian equities, obviously without the liquidity, right? Yeah. Without the liquidity. But that's a lot of work to do on your own. And then, if we were to choose a fund such as yours, potentially, obviously being a good GP, you get hopefully do better than the 10.6 or 10%, right? And as a business model, I think we talked about this, you're almost like a hybrid fund of funds, right? You take investors' money and then you find essentially operators and then you back them into a joint venture. They do the work, you help out, and then towards the end you kind of split the profits, right? And then as long as you do that well, then the investors at your level hopefully will get the returns as well on a long-term basis, right? Is that sort of a kind of, and then again, because it's such a uncorrelated asset class, you're getting allocations from institutional investors because of that.
Yes, and that's exactly right. The trade-off here is illiquidity for non-correlation. Because if you think of a 10-year fund, we really aren't providing the liquidity options that you have when you're in a stock market.
Yeah, okay. All right, so let's, okay, since there are a lot of questions, I think the first one we talked about it, Clifton asked about the idea of investing close to metro areas. Is that getting your extra capital gains? It sounds like a very smart Clifton question, but that's really not your strategy. And right. Again, from the data that I did see, Ontario had great gains. That's probably driven by the growth of Toronto condos, right? But that's, again, that's really not your play. And that's why you keep the non-correlation. Right. With commodity-like volatility for farm crops, how does that impact cash returns over a 5-year period? Maybe you want to talk about that a little bit?
Yeah. So commodity volatility definitely plays in. It generally is 70% of the volatility is hedged out by the Canadian dollar. So 70% of what you read about in the newspaper is actually probably a little more tied to oil, and so is the Canadian dollar. So it's hedged out. So much bigger than commodity prices, volatility in farm income will depend in Canada a lot on weather, because for the most part, we are not on irrigated ground. So we aren't putting the water down. So if there's lots of rain, we're doing well. And if there's not a lot of rain, we're not doing well, is the easiest on that. And commodity prices play into it, but in general on our returns, when we look at it, they'll swing the returns by 10%. Weather can swing the returns by 30%.
Okay. Question about increase in value from harvesting lumber, conversion to higher yielding crops. I think you talked about, is that a good strategy? I think you touched on that, maybe just kind of a bit more on that, Joelle?
Yeah, we generally aren't actually the people harvesting the timber. So that is a business and there are people who are doing it. But because of that, the land is more competitive and it's really, really expensive and difficult to get rid of stumps. So we focus on land that has been timbered and is now kind of in overgrowth or recreational state, and we're bringing it back into crop production. It has been a very good business for us. It takes a ton of management oversight and building up the capacity and the experience. We are running the biggest of that in Canada. So at the moment, we think we've cleaned up more land in Canada than any other entity. And through that, built a lot of experience that is helpful to us as we continue to grow in that space.
Okay. I think we touch upon a bunch of those. We can open up for more on climate change. David had a question about your thoughts on water rights and ownership of water and farmland if something you want to look at investing. Thank you.
Okay, so in Canada, it's not super important because, like I said, most of our land is actually rain-fed. We are not irrigating. But in anywhere where you are irrigating or need to irrigate, so where you're watering the ground, water rights are super important. And in some geographies, those water rights run with the land, so you can't invest separately in them. But in other geographies, certain parts of Australia and elsewhere, those water rights do not run with the land. And so you can actually buy and sell water rights independently from land. It is an extremely interesting area. I think it's a very valuable asset class. It runs also not correlated to, depending on how you're doing it, it's not correlated to farmland, probably not correlated to other assets, mostly correlated to rainfall in the specific area. And then that's a super interesting investment center, just not one that we deal with. I think David also asked about government incentives.
Yes, he did.
For owning, growing, managing lands. So there's two ways that we get government incentives, and we do benefit from them. One is in land that we clean up in certain regions, the government either subsidizes the improvement work or writes us checks for reimbursement for the improvement work or growth of the company. So if they want to incentivize more economy in the area, then they actually subsidize the buying of equipment and things like that. And if they want to incentivize additional acres, which is often what we see, then they will, they'll actually give us checks back when we spend money on land improvement, which we have benefited from. The second and the bigger one for agriculture across Canada and the US and other geographies is income stability through crop insurance. So the Canadian government, provincial and federal, partner to provide a subsidized insurance program available to farmers called crop insurance. The government pays part of the premium, the farmer, so as us, we pay part of the premium. And that gives you downside protection for years when the weather is bad. In Canada, that is a yield insurance. So it doesn't insure you against market price fluctuations, but it does if there's bad weather, which, as I explained before, is a bigger part of it, but there still is a market impact. In the States, it's actually a revenue insurance, so either a margin or a gross insurance. And so it actually does insure you for market price movements or yields. It doesn't last forever because it's running off of a rolling average of your farm. So if you get sustained bad weather, it's not going to help you very much. And if you get sustained poor market prices, it's also not going to help in that situation very much. But as a year-to-year kind of problem cover, it is super helpful and highly subsidized.
Okay. Let's see. I'm going to just, I see one question from my daughter, so I have to ask this one.
Yeah.
I think the question was, we kind of touched it maybe a bit more. Does COVID make your crop portfolio, does it impact any certain crops, or do you see opportunities because of COVID to change into other crops? I think that was a question.
That's a great question. We actually, because we're an annual crop, so we get to plant each year, our farmers are making their decisions on what to crop basically right now. So they have a plan, but they can start varying that plan based on the markets. Wheat is reasonably highly priced. Some of the other commodities that we will grow, like canola, are actually lower priced. Part of that is Canada still can't send canola seed to China, which was a big export center, and because of a trade dispute. Even though you can make an annual decision, you're also making crop rotation decisions. So we will grow we do a 3-crop rotation or 4-crop rotation depending on the farm. So we'll grow wheat, and then we'll grow canola, and then we'll grow soybeans, and then we'll go back to wheat, for example. If you do wheat and then wheat, which you can totally do, you then have to decide, do you want canola and then soybeans, or do you want canola and then back to wheat? You can't do canola and then canola because it carries too much disease risk. So your decisions are, we think there's probably a 35% change that you can make on your farm. There isn't 100% change that you can make according to plan, because you still need to have really good agronomy. You want soil health, you want productivity of that land. So it is changing what we pick because we're picking things that are more important for people to eat, like wheat, than for animals to eat, like canola meal after you take out the oil, which makes part of its price. But with all of that, even with our very best decisions, even if we had a crystal ball, that can let me change about 35% of my crop according to my plan, as opposed
to. What about the increasing trend towards food security and regionalism? What percentage of your portfolio are exports to China, for example? And is that a big risk?
About 75% of our portfolio is exported. So about
wow.
75% of the kind of grains that we grow. And we actually see that as a pretty big opportunity. When you look at food security, it doesn't matter what your food is, Canada is going to be relatively secure. So if you have something that can easily get exported, that's probably an opportunity in kind of the global scheme of things. We're expected, especially as climate affects countries and makes them less productive because of both erosion and drought, we are expected to increase productivity, and there is expected to be a greater demand for that food.
Okay. We're 10 minutes left for the soft stop at 9. I'm going to just unmute since we have a small group. Maybe just the folks that have burning questions can address them directly, but I just asked that those that are not talking to maybe mute themselves.
I'm going to live in my car.
I think, is that Richard? Hey, Richard, do you mind muting yourself?
You never seen my sister's car. She's terrible.
I need my shit to look.
He might be saying.
Okay, I'm going to just mute all, but I think the folks that want to ask questions can unmute themselves. In the meantime, I think there is a question. I'm just going from the bottom up now. What are some investment vehicles, ETFs, that can offer exposure without actually buying land? Yeah, I think that's a good question because you have minimums and so you're not that liquid. Are there ETFs? Are there other products that they can get exposure besides you? Oh, you get to unmute yourself.
Sorry about that. There aren't ETFs that I know of that do a good job. So there are agricultural ETFs, but they'll invest in John Deere and Pioneer and other businesses that service farms as opposed to farmland, which is the asset class that you're really trying to get exposure to. The businesses that service will depend a lot more on the operations, so on how well a farmer does, whether they can spend money on a new tractor. So for exposure to farmland, there are some publicly listed stocks. There's a couple in the US. I don't like them that much because for whatever reason, they actually trade below NAV. So it's, and they don't trade a lot, like there doesn't seem to be a ton of liquidity in them. But if you're looking for exposure that gives you some liquidity and farmland, I would actually look at farmland stocks. I don't know how they get valued. I don't know how strong the assets are that are in them because we haven't looked to do that. But that probably gives you your most direct exposure and keeps your liquidity. You're probably paying in one way or another for keeping that liquidity. But that's what I look at.
Yeah. I've met 2 startup companies. I think one's called Acre Trader. They're I think out in the States somewhere, and then there's a company called Farm Together, which is a Canadian, and they're kind of like crowdfunding. Like they would buy a farm, and then you can essentially participate in piecemeal into I think a percentage of the LLC or something, right? But again, that's so individual. It makes it easier because they do the management. They take a fee as well. But so it's a smaller slice than you would do yourself, but obviously it's not a portfolio of assets that Area One provides, right? Yep. So I haven't found anything similar in Canada. In the US, I've seen a few farmland funds, but I don't know. Victor, are you still on? Victor from CPPIB or Clifton, have you guys seen? I think there is some interest in looking at playing this asset class potentially, or at least exploring, but without having to plop down big dollars or be locked up for 10 years?
Yeah, we do. A few years ago, we did invest in farmland a bit because the benefit of diversification, as as the speaker said, but the market size was fairly small, so we didn't grow that much. Yeah, it has its attraction because the diversification does not correlate to the stock market.
So just for the benefit of the audience, Victor, who just spoke, retired recently from CPPIB, as you know, Canada's largest pension fund, where I think for most of your time, Victor, you handle real estate, and then you also did a bit of blockchain and other assets, right, Victor?
Yes.
And so when you guys are looking to do $200 million checks?
Yeah, for real estate, we generally $200 million minimum check. Yeah.
Okay, so you're saying it's just not enough for you to deploy.
Yeah. To put that in context, like if you look at our farm, so let's say the example I said before, where we're going to try and build 10,000 acres, we're going to do that at $1,000 to $2,000 an acre. So we're going to have a total of a $20 million investment. We're going to make about 7 to 15 separate purchases in order to achieve that. And 85% of those purchases, so probably 7 to 9 out of those purchases or 7 to 12, I guess, are going to be off market. And so building the kind of scale that CPP looks for in assets is hard to do in Canada. It's actually not as hard to do in other countries because farms in Canada are much smaller. So in Australia, you can buy some farms that are $50 million purchase at once, but that isn't the context generally of farms here.
Victor, can you comment, I don't want to say challenge, but from what you've heard today, my basic questions, because I'm not deep in this space as you and Joelle are, and what Joelle has presented or shared, from your experience in looking at real estate, and again, farmland real estate, is this what you've seen in terms of the trend, in terms of our assessment? Or do you have a different view?
What when you say trend, what type of trend? What do you mean?
Do you find Joelle's view of farmland investing in Canada accurate, or do you have a different view?
I don't know enough about farmland to make that comment. I'm because I cover mainly from real estate.
Gotcha.
I would say that I would say that the diversification probably is the main drawback. I would say the things probably a little bit more risky is the commodity risk exposure and also exposure to the weather that can make I would say the yield return a little bit more unpredictable compared to say commercial real estate, or let's say by infrastructure. If you buy a toll road, you can maybe you have a much more predictable cash flow. Of course, there's always a risk, and that you get paid for taking that risk.
Yeah, I would very much agree with that. So I would say to potential investors that we talk to, we don't give us any money where you need the return to buy milk and eggs, because we're not a bond. And because the history in farmland in Canada has actually been pretty stable in terms of appreciation, people really do look at it, I think, and I don't think everybody does, but I think there's a subset that look at it as a bond replacement. And that's okay if what you want is a long-term something, but it certainly isn't a stable income.
Okay, thank you. Thank you, Victor.
Thank you.
Clifton, you want to tell us about land? I've not heard of that as an option.
I don't know enough about it to kind of push it or not push it, but in my review, I agree with Joelle that generally the ETFs, particularly today, are selling at substantial discounts from net asset value. to me, that's kind of attractive. If I can buy something at, say, 50% of net asset value in the public markets that the REIT would have to go out and pay, 100% on the public market, that's probably a good buy over time, as long as you expect that there be some kind of return to mean situation occurring over time. You've got to look at the business strategies, and you've got to look at the underlying ability of the managers to execute on those strategies. But I'm not afraid of the idea that the REITs and ETFs are selling at a discount to net asset value. That's kind of an opportunity, in particular, the market today.
Okay, and so is land is a U.S. farmland ETF?
Yeah, and I think their strategy is they're regarded as pretty good investors, and their strategy is to actually go with higher end crops, like blueberries and strawberries and stuff like that. They tend to buy closer to urban locations, so they kind of dangle that potential. I haven't looked at it enough as to whether that's actually been realized. And after listening to Joelle, I'm going to be a little wary, because they're probably paying, $70,000 an acre when Joelle's paying $2.
Is that true, Joelle?
Right.
The range is like that, and some of it's justifiable, and then some of it becomes potential. So even in our portfolio, the cheapest stuff that we bought once improved would end up being about $1,200 an acre Canadian, so about $800 US. And the most expensive that we bought would be about $12,000 an acre Canadian. And we buy a little bit that's closer to cities. It has higher productivity. The difference that I can justify between those two is probably $6,000 to $7,000 an acre of the difference. So I can't get quite up to the full 10, but for $3,000 an acre, I'm in city limits. I have some access to services probably in the next 20 years. I'm thinking that maybe that spread will become a little bit different. So I'm not totally against the idea of buying some stuff that's close to cities. I just think that if your portfolio is really about farmland, you better keep it mostly about farmland. And other strategies that work. So if I could make a $40,000 acre pay for itself, like in the same way that I can with a $2,000 acre, I would do it for sure. So in our most recent investments, so the 2 investment tickets we took to the committee actually today, one was the 10,000 acre place I explained to you. We'll end up with about $1,000 an acre in it, in an area worth $2,000 an acre. At the same time, we took another one, we'll end up with $5,000 an acre in it, in an area worth $10,000 an acre. And I would do as many acres as I could in that really good area, because I can still make it work. So I'm not against more expensive land. It's a little bit harder to justify if you don't have the income from it. Then probably if you want to be speculating on land for buildings, you should be a builder, not a farm person.
Can you make the $10,000 an acre or $5,000 an acre numbers work with wheat, or do you have to be at different types of crops?
You have to be with different types of crops, but they don't have to become crazy crops. So you don't need blueberries. You do need soybeans. And if your land is that expensive, you're probably in an area where soybeans work. And if you want to make the cash flow work as well as you do in the $1,200 an acre area, you actually probably want some navy beans or some lentils or something else that's kind of human consumable and more expensive. But again, not wild for the area. So I like we've been debating this a lot internally, because on $6,000 acres, I can find really, really straightforward, totally on normal rotation, 3.5% cash return from operations. On $2,000 acres, I can find a 5% return from operations, from cash flow. For 1.5%, if the $6,000 acres are in an area that has historically gone up in value faster, maybe it's worth having some there. And so the reason that we actually focus so much on land conversion is we can end up in those better areas with a lower cost, and then I'm not worried about it at all. Because if I build the land for half the price, then I don't even have to farm it for 3.5%. I can rent it out for 5%, just because we're at half price. Like that's really 2.5%. And so it's a lot of what draws us to land improvement work. But I think as an investment, I would not worry about the difference between a 3.5% return and a 5% return on income. I would make sure that you're buying well. And that the price you get, like most other real assets, and especially kind of capital intensive assets, you make your money when you buy. And so you want to make sure you're buying really good quality stuff and you're buying it well. And that's how to pick a manager.
Okay, so we're past 9. We said soft stop at 9, but we can. I think there's a couple more questions, general ones, that we can go through, Joelle, if it's okay with you. But if the folks that do need to leave by 9, please feel free to do so. There was a question about difference of Canadian versus U.S. farming, I believe. If you could address that. Again, anybody else that have questions, just please either pipe in live or just text it.
Your big differences, Canadian versus US, will very much depend on where in the US and where in Canada, but Canada's a little bit more similar, especially the areas that we end up in, than the US. So California is going to operate very differently than Montana, which is going to look a lot different than Michigan, which is going to look a bit different than North Dakota. But your biggest on row crop commodity is how stable are the buyers and why are they buying? And on the operating side, is it nice, consistent operations? Consistent operations mean 2 things. They mean weather and they mean market prices. The Canadian dollar seems to hold the market price better. I have a little bit of a controversial view on that. So understand that it is not made with really great analysis. It is my view, and it may be wrong, so judge it accordingly, which is, I think the way that the commodities are generally priced in US dollars. Canola is priced in Canadian, but otherwise you're on a US base. When we talk about low commodity prices, you are really seeing an appreciating US dollar relative to other exporting countries. If you rebalance the cost of goods based on the dollar of the exporting country and you just make it proportional, you would have the US dollar mixed with Canadian, mixed with Brazilian real, mixed with Russia, mixed with Australia. Except for the US dollar, all of the other currencies relative to the US have gone down over the last 5 years because they are oil correlated dollars. So I don't think you're really seeing depressed commodity prices. I think you're just seeing an appreciating US dollar, which when you're in Canada or Australia or Brazil on land isn't a problem. But when you're in the US on land, it is going to be a problem. So that's one thing to keep in mind. The second, and I think one thing that is undervalued a little bit in this area is your buyers really differ. So in the US, land rental is much more common. And so farmland can trade a lot more like cap rate. And so it will depend a bit more on what somebody is willing to rent for. In Canada, rental is less common. It'll trade much less on cap rate. It'll be a little bit dependent on rent. It will all end up meaning if the farmer who's renting it isn't making money, your rent's going down too. And so it poses similar risks, but they're not exactly the same. And so you want to think about who are your other buyers and what matters to them as potential drivers of value. and what currency are you in, and how exposed are you to that currency separate from commodity prices?
From a return standpoint, Joelle, it's been at least 6 months, but I recall around 6 months ago, I was able to meet at some conference and get the placement memos of 2 farmland funds, US focus. And so it could be a GPO, it could be a asset issue, but I remember they were saying they were the top GPs. I don't want to give any names, but the returns were significantly below the average of the Canadian, the 10.6. And then what I didn't like most was in the last 5 or 6 years, it was a declining return. So I'm just wondering, is that representative of U.S. farmland as an asset class, or is it just those 2 bad GPs?
I don't know, because I don't know it enough. The part that I do think is probably right, because I've asked some of the U.S. firms like ours about it, is your very best land probably didn't come down in value much, and your worst land probably came down in value more. So in an appreciating market, your better and your worst stuff in an area get closer together, which should mean that in a depreciating market, your better and your worst stuff get further apart. So it probably depends more on the quality of the assets that they bought, not necessarily what they think they bought, but what they actually bought, in terms of how they do. It's like other things, like you're buying an asset, you want it to go up, you hope it goes up, you want to be in an area where there's going to be a reason for it to go up. So we look at, will crop yields increase and will profitability increase? And I think to some extent in the US, some of the issue has been the drop in commodity prices. I don't know how that plays out. That said, your certain specialty crops, almonds get talked about a lot, oranges, things like that, they're a totally different market. Like, and some of those can operate a little bit more like monopoly markets. They're more at risk to insects and different things that can actually hurt what are otherwise supposed to be permanent crops. But they're a very different standard, and I don't know as much about them.
Okay. I think Clifton just popped a question that I wanted to ask. It's a great question, I think. Energy prices are low. Can you buy farmland based on farmland economics in Calgary that have oil right opportunities?
Canadian, so it's a really good question. Canadian farmland, Canadian oil, unlike the US or certain parts of the US, almost never do the mineral rights go with the land. The mineral rights are almost all government. So farmers get paid a rent for where the oil well actually sits. And when you buy land, you pay for the land, and then you pay some multiple of the rent for that, for the oil wells, because you're seen to get it. Oil companies have stopped paying those rents in some cases. And so there is some risk to all the land we bought, for example, where we did pay for oil rights or those rental rights, but it doesn't actually improve much in terms of the land you're paying for the land. Like, you might get the oil wells for free now, but you're not getting mineral rights. And the farmland has been appreciating. So we lost in 3 different purchases in the last 2 weeks in Alberta.
Okay. Great. Okay, I think we'll wrap this up, Joelle. Thank you so much. This is really quality content. And then I think David sent the link to the land ETF. It looks like that's a correct one. I will also go look at it because, again, liquidity does matter for some investors, and not everybody can. Land is a read. Clifton says land is a symbol. Okay, got it. Land is a symbol. Great. So, Joelle, you'll also be the guinea pig. My virtual assistant, Clifton, quit on me yesterday from the Philippines. And so I found an app called Otter that is AI that will supposedly transcribe automatically this entire webcast. So we'll put this, we'll see. So you're going to be the guinea pig. So we'll put the transcription on our website. The webinar will be on YouTube. and then someday we'll transcribe this into podcast, and hopefully we can also put this all in the book as well, because there's a lot of good content here. So, Joelle, thank you very much. And,
if anybody has other questions to follow up or wants other additional information, I travel about half the time, and now I'm traveling not at all. So I have time to answer. So just email me.
Yeah. How do they get in touch with you, Joelle? Do you have a LinkedIn? Do you have is it just Joelle Faulkner LinkedIn?
Yeah,
is that you prefer?
That's easy. And for email, it's joelle@area1farms.ca.
Great. Okay.
Perfect.
All right. Thank you, everyone.
Thanks,
Have
everyone.
a good night. Joelle, thank you.
Night.
Thank you. Yeah. Bye.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.